Subscribe to my channel Report Stock.
Okay, let's unpack this. Imagine a major bank, right? Not just getting by, but actually thriving in this global economy that's still got all these whispers about headwinds and, uncertainty. Sounds almost like, well, a magic trick, doesn't it? But that's pretty much the narrative we're seeing from Bank of Montreal, BMO, in their latest financial quarter. Today, we're taking a deep dive into BMO's Q3 2025 earnings. We've gathered a whole stack of insights here. We've got their official earnings call highlights. We've looked at analyst perspectives, and we even uncovered a few, well, warning signs that were flagged by Guru Focus. Our mission, it's really to cut through all the financial jargon, figure out what's truly driving these pretty impressive numbers, explore the challenges maybe hiding beneath the surface, and ultimately work out what it all means for you, the savvy learner, just trying to understand the bigger picture of, our financial world.
Yeah, it's fascinating, isn't it? Just the sheer resilience a company like BMO seems to be demonstrating right now. We're not just going to look at the headline figures. We need to peel back the layers, understand the why behind them, connect their specific performance to these broader economic currents. It really is a compelling story. It feels like a tale of two economies, almost, playing out inside one single institution.
Okay, so here's where it gets really interesting. And, kind of eye-opening. BMO reported some genuinely striking figures for Q3 2025. Net income hitting $2.4 billion.
Wow.
Yeah, and get this, that's their second highest quarter on record.
Second highest, okay.
And their earnings per share shot up a solid 22% to $3.23. That's a significant jump from $2.64 last year on an adjusted basis. These aren't just, good numbers. These are numbers that make the whole industry sit up and take notice. And it's not just the top line either. You also see a really strong return on equity, ROE, which improved nicely to 12% for the quarter. Then there's their pre-provision pre-tax earnings, PPPT. That hit $4 billion, up a healthy 13%. And year-to-date, PPPT is up an even more impressive 19%. These aren't just random metrics. They're powerful indicators of how efficiently and, frankly, how profitably BMO is running its operations.
Exactly. And when we connect this to the bigger picture, these numbers speak volumes about really robust operational efficiency. Think about this. BMO has achieved positive operating leverage for 6 consecutive quarters. 6.
That's quite a streak.
It is. It means their revenues are consistently growing faster than their expenses. That's a critical sign of a very well-managed institution.
Yeah.
It's like having a high-performance engine that's also, incredibly fuel efficient. And their Common Equity Tier 1 ratio, the CET1, it stands at a formidable 13.5%.
13.5. That sounds high.
It is. Think of CET1 as the bank's ultimate safety cushion, right? Their purest, most reliable capital reserves. So a high 13.5% here indicates they have this really strong buffer, a formidable buffer to absorb unexpected losses. And that lets them confidently continue with things like share buybacks, supporting client growth, without really skipping a beat. It's a powerful signal.
Okay, so digging deeper into where this growth is actually coming from. We see some truly standout performances within their specific business segments. Their U.S. personal and commercial banking net income, for instance, increased by a remarkable 42%.
42%.
Yeah. That's not just a leap, that's like a gigantic stride, right?
Right.
BMO Wealth Management net income, also strong, up 21%. BMO Capital Markets saw a 12% increase. That shows good activity, smart positioning, and investment banking.
Right.
And even their Canadian P&C revenue was up 6% to $3.1 billion. So it contributes nicely to this overall picture of pretty widespread success.
This really brings up an important question, though. How is BMO achieving this kind of differentiated success, especially when some of these numbers seem almost counter-cyclical to the broader economic trends we're hearing about? Part of it is clearly strategic. You mentioned the acquisition of Burgundy Asset Management, for example. That move is expected to significantly enhance BMO's wealth management, their financial planning capabilities. It expands their reach and services in what's typically a high-margin business. And their capital markets' strong performance. That's driven by increased underwriting, advisory fees, trading revenue. It really highlights their ability to capitalize on specific market conditions, client demand, whether it's IPOs, complex financial solutions, or just navigating volatile trading environments. It seems to be about being agile and having the right people in the right places.
But, as we always say here, the full story, It always has more layers, doesn't it?
Always.
While those headline numbers are, undeniably strong, our sources point to some areas where the picture gets a bit more complicated, or at least requires a closer look. For example, Guru Focus, which is a well-respected financial analysis platform, actually detected 5 warning signs with BMO in this very period. They urged caution.
5. Wow.
Yeah, now that's quite a flag, isn't it? 5 specific concerns that might just, temple this otherwise really stellar report.
That's a crucial point. And it perfectly illustrates this tale of two economies theme we mentioned earlier. What's fascinating here is the contrast within BMO's own operations. So while Canadian P&C revenue is up, their Canadian personal and commercial banking net income actually decreased by 5% year over year.
Okay, so revenue up, income down. Why?
The main reason, higher provisions for credit losses, PCLs. And this isn't just some technical accounting hit. It's a pretty stark indicator, actually, of how things like rising interest rates and inflation are directly impacting the Canadian consumer's ability to pay back loans. It creates this ripple effect right back to the bank's bottom line. It really reveals a specific vulnerability in the Canadian market that just isn't mirrored in their surging U.S. performance.
Right.
And Guru Focus, for instance, they might be looking at metrics exactly like these increasing PCLs, or perhaps concerns about future cash flow relative to debt, things that are maybe more subtle than just the big revenue numbers.
Okay, that makes sense. And speaking of loans, in the U.S., commercial loans actually declined. Now, our sources confirm that's not just a BMO-specific challenge. It seems to be largely due to, muted loan demand across the entire industry that impacts overall loan growth.
Industry-wide pressure.
Exactly. So while some areas of their U.S. business are absolutely surging, the core lending machine is kind of feeling the pinch of these broader economic trends. It creates a bit of a mixed picture performance-wise. It's not a direct warning sign from BMO's management itself, maybe, but it's definitely an external market force they're having to navigate.
Which then leads us to a critical question about managing future profitability, right? Expenses grew by 7%.
7% increase in expenses.
Yeah, driven notably by higher employee-related costs. Now, if that's not managed carefully, this could really start to pressure margins down the line. It could erode some of the gains from that strong revenue growth. It's this constant balancing act, isn't it? Investing in talent versus controlling the cost base. And of course, there's the ever-present macroeconomic outlook, still uncertain. Potential risks from, say, trade policy, fiscal policy developments. These things can swiftly change the operating environment for a large, globally exposed bank like BMO. These external factors are often what platforms like Guru Focus flag, not necessarily internal mismanagement, but these potential external headwinds building up.
And here's a detail that feels quite sobering, brings it right back to the real world.
Yeah.
Our sources indicate that impaired provisions in Canadian unsecured retail portfolios increased.
Unsecured, okay. Like credit cards, personal lines of credit.
Exactly. And this directly reflects real-world unemployment and insolvency trends happening in Canada. It tells us a lot about how individual Canadians are actually coping with these economic pressures. When the bank sets aside more money for these specific provisions, it's because they see a higher likelihood that things like credit card balances or personal loans won't be fully repaid. It's a very tangible sign of consumer stress hitting the bank's loan books.
A very direct link.
Yeah. Now, diving deeper into this complex picture, the earnings call Q&A sessions, they're often where the deepest insights hide, right? Where executives have to address the tough questions that analysts are pushing. And we've pulled some key highlights for you directly from those discussions, which really help unpack these nuances.
Okay, so one of the central themes that came up, especially regarding U.S. loan growth and the potential impacts of what's sometimes called debanking.
Right, where banks might limit services to certain sectors.
Exactly, often due to perceived risk or maybe regulatory pressure. CEO Darrell White and Aaron Levine, who heads up BMO US, they clarified that despite these broader macro factors influencing the outlook, BMO's U.S. commercial and wholesale businesses remain remarkably strong. They're actively optimizing their portfolio, they're managing those PCLs we talked about, and they're focusing on high-return assets. It sounds like a strategic pivot toward quality over just sheer volume.
Quality over quantity.
Precisely. Emphasizing that strong relationships across their business segments provide a solid foundation for growth, especially in perhaps less volatile areas like personal loans and deposits. This selective growth seems key to their U.S. success story right now.
Okay. And another interesting follow-up question revolved around the integration of their U.S. wealth business into the U.S. P&C segment. The question was, does that affect their 12% ROE target?
Good question.
Yeah. Aaron Levine confirmed the integration aims to enhance connectivity across business lines. He believes it will ultimately benefit the wealth business by creating stronger ties with the personal and commercial banking sectors. Makes sense. However, Tifin Tuzun, the CFO, stated pretty unequivocally that the 12% ROE target remains unchanged.
Unchanged. Okay.
Yeah, he noted that while the wealth business contribution is important strategically for client relationships, its relative size just doesn't significantly alter the overall target. So clear vision there, stable targets.
That's right. And on the credit side, a particularly interesting point was how performing provisions actually recovered in the U.S.
Recovered. How so?
Well, Piyush Agrawal, the chief risk officer, attributed this to an improved macroeconomic outlook in the U.S., combined with faster stabilization of their portfolio quality. Essentially, the resilience of the U.S. economy has meant credit performance there has been better than they previously anticipated, which really contrasts with the situation we discussed in Canada. And while, there might be some variability going forward, the outlook for credit quality remains generally positive for their U.S. operations. It suggests a more stable environment for their loan books there. It really does underscore that tale of two economies within BMO, doesn't it?
It absolutely does. So, okay, what does this all mean for Canada's economic health from BMO's direct perspective? Daryl White characterized Canada as experiencing, quote, modest growth, with most industries being USMCA compliant, which indicates a, stable trade environment within North America.
Modest growth. Okay.
Yeah. And while there are certainly uncertainties, he mentioned potential tariffs that could impact various sectors, the overall environment isn't seen as recessionary. So they remain optimistic, but it's clearly contingent on how macroeconomic and trade developments unfold globally.
Kind of cautious optimism, perhaps?
I think that's a good way to put it, cautious optimism. And just to circle back to those future PCLs, those provisions for credit losses, Daryl White highlighted that they're just one of several factors in overall performance, suggesting the bank looks at a more holistic view of risk and reward, not just PCLs in isolation.
Right. It's not the only dial they're watching.
Exactly. And Piyush Agrawal added that while credit performance has significantly improved in some areas, external factors like trade policies, unemployment rates, they will undeniably continue to influence future PCL trends. So they anticipate some variability in credit provisions moving forward, but they express confidence in their proactive credit management strategies to mitigate these risks. It's clearly a continuous, dynamic process for them, not a static target. So wrapping this up, what does this all mean for you listening in? BMO's Q3 2025 results really give us a powerful lesson in looking beyond just the headlines. We've seen a bank achieving near record highs, showing off impressive financial strength, strategic wins, particularly strong in the U.S. and their capital markets. Yet, at the very same time, they're navigating some very real challenges in their Canadian personal and commercial banking sector. They're carefully managing expense growth, and they're operating under this persistent cloud of macroeconomic uncertainty. It truly is a delicate balancing act, maximizing opportunity while meticulously managing risk.
Yeah, this deep dive really shows us that even in what looks like a strong financial report on the surface, there's always a nuanced, multifaceted story to uncover underneath. Understanding where the strengths truly lie, and maybe where the pressures are quietly building up, it helps us appreciate the immense complexity involved in managing a major financial institution in today's interconnected world. It really encourages critical thinking, doesn't it? About how banks are attempting to balance these ambitious growth targets with the absolutely essential task of rigorous risk management, especially concerning credit quality and just adapting to broader, sometimes conflicting economic shifts between regions.
Absolutely. So here's a final thought for you to chew on as we wrap up. What does BMO's Expert Balancing Act, this simultaneous pursuit of record profits while carefully managing credit provisions and navigating these uncertain economic waters, what does that tell us about the current state of the global economy? Especially that contrast between different markets like the US and Canada we saw here. And maybe how might you apply this kind of analytical lens to other companies or sectors you're following, looking for those same underlying tensions, those strategic responses. Keep asking those questions, keep digging for those deeper insights.
Subscribe to my channel Report Stock.